Peter, but you'll be on a little later in another round. Mr. Poilievre for 5 minutes, followed by Ms. Kotrakis. Mr. Poilievre?
Yes. What share of the new debt the federal government has added since March is locked in at current rates for 10 years or more?
Well, you'll have to ask the Minister of Finance does debt management, so you're going to get an update on I guess next Monday.
Okay, so you can't answer that question.
No, that's a question for the Minister of Finance. I
Okay.
can tell you. What's on our balance.
No, I'm not asking about your balance sheet. I will get to that in a moment. But who sells the federal government's debt into the market?
We are the agent of the government. We run the government auctions.
So you are responsible for it then. You would know then what share of the new debt is locked in for 10 years or more.
Pierre, we will have to give the governor time to answer. These are very, very important, and I'll not take this time from you, an important issue, but I don't want to be down with the governor of the Bank of Canada to a 4-second question and a 4-second answer, so we are going to have to give at least minimal time. Pierre, go ahead.
I'm done. I asked my question. Still waiting for an answer.
I don't have the full term structure of the government's debt in front of me. It changes these numbers change regularly.
Right.
As you well know, the debt is evolving. So, the term structure is evolving. The government,
so you don't
is in the process of terming out.
That's all right. Your bank is the one that's issuing the debt, but you don't know how much of it is long versus short term. We keep being told that there's no risk to all this debt because it's all going to be locked in for the long run. But the data that's on your website shows that 91% of it is for terms of less than 10 years and susceptible to interest rate hikes. Back in 1978 through to 1980, interest rates rose. They tripled. They went from 8 to 22%. No central banker planned that or anticipated it, and yet it happened. And the Canadian economy suffered as a result. But forget an increase by triple. What would be the cost to the federal government of a 1 percentage point increase in the effective rate of interest on its debt?
Well, the current debt's about $1 trillion. So you can multiply 0.01 by $1 trillion. That gives you the steady state increase. In practice, of course, that debt is of varying maturities. So in the first year, it'll be the amount that rolls over in the first year.
Right.
In the second year, so when the whole thing rolls over, it'll be 0.01 times $1 trillion. That could take several years.
Okay. And what would be the effect of the cost to the Canadian economy of a 1% effective increase in the interest rate?
You want a GDP number? What do you want exactly?
Dollars.
Well, the situation in which we'd increase interest rates, the economy will be in a better situation than it is now. So
you can't give a number for that.
We're not, as we've indicated from our forward guidance, we're not contemplating raising interest rates at the moment.
Right. Well, as I pointed out earlier, the governors don't always contemplate interest rate hikes, and they happen anyway because of changes to market conditions and situations that are unforeseen. Let's move on now to the QE program, which is the massive purchase of government securities by the central bank. You said a moment ago that your bank actually sells these securities to the marketplace and then buys them right back from the same investors to whom you sold them. What is to stop an investor from profiting off the difference between the price of a government bond or treasury that you sell them and the price that you pay to buy them right back?
Well, these are both of these are done in competitive auctions. The auctions are heavily oversubscribed. There's lots of bidders on both sides. So it's a competitive process. And I think that should give you some assurance that
I have no doubt it's competitive, but you've stated that the purpose of quantitative easing is to drive up bond prices. And so presumably you're paying more for the bond after you've increased its price through your actions than you sold it for. And the difference is profit to the investor that bought them from you and sold them back. And ultimately, that cost has to fall on somebody's shoulders. Who actually pays that price?
Well, as I said, it's a competitive process. Yes, we are exactly as you indicated. The way quantitative easing works is by buying the bonds, that creates more demand, which pushes up the price and lowers the yield. And that is how we're delivering monetary policy, lowering the cost of borrowing for Canadians.
Right.
That's what it's doing.
But you're pumping $400 billion into financial markets, inflating financial assets, and enriching the people who own those assets, who are overwhelmingly affluent and well-to-do people. And in the process, you are diluting the wages of working class people. Your own policy paper from your bank shows that inflationary costs are borne disproportionately by the poor and the disadvantaged. So you're effectively transferring an enormous sum of wealth to those who have financial assets while diluting the wages of working class people. Are you not worried that this is going to expand the gap between rich and poor?
So let me unpack. There's a couple parts of that question. So let me unpack it. First of all, I agree with you entirely that inflation is borne disproportionately by less wealthy people. They tend to operate more in cash, and so they tend to disproportionately bear the cost of inflation. And that's exactly why, that's an important reason why the mandate of the Bank of Canada is to maintain low, stable, and predictable inflation. That's something we can do for society. Right now, inflation is actually too low. It's below our 2% target. It was 0.7 in October. There's, as you're well aware, over 600,000 Canadians are unemployed. There's a lot of downward pressure on inflation. We're more worried about it going even lower, which can be harmful for other reasons.
Thank you. Thank you. Well, I would just point out
we are over time considerably.
Can I
Pierre.
ask a 10-second question?
No, we're already a minute over. I'm not sure if Mr. Macklin had finished his answer. I was going to give him time to finish that very deep question. Are you complete, Mr. Macklin?
Yes, I think I'm complete.
All right. We'll likely have a little time later, Mr. Poilievre, because we've got an hour and a half with these witnesses. Ms. Koutrakis.
Thank you.
Thank you, Governor and Senior Deputy Governor. Thank you for appearing before our committee this afternoon, and thank you for the service that you do for all Canadians across this beautiful land. I believe that the government's response has measured up to the unprecedented health and financial crises. We are starting to see the rebound leading to
next round with Mr. Poilievre for 5. Mr. Julian.
Thanks very much, Mr. Chair. Thank you, Governor Macklem. Thank you, Deputy Governor Wilkins, for being here today. Yes, we always appreciate your visits to Finance Committee, and Deputy Governor Wilkins, we wish you all the best in your future. We certainly hope during this pandemic that your families and your loved ones are safe and healthy. And this has been a traumatic and tragic period in Canadian history. What many people have attributed as the biggest convulsion through this pandemic that we've seen since the Second World War. Now, as you recall, in the Second World War, both through the war and in the aftermath, there was a change in function and mandate for the Bank of Canada. Now, many people, including dozens of economists this week in Le Devoir, have pointed to other central banks like New Zealand, where the mandate has been enlarged. Now, for a generation, we've been focused on inflation control. People are saying, many people and economists are in agreement that the mandate should include for example, pushing back against the massive inequality that we've seen through this pandemic, dealing and supporting the transition that we have to make to deal with the climate emergency, even looking at full employment. And I'd like your reaction, Governor Macklem, to these voices saying that the mandate needs to be broadened so that we can tackle the challenges that we have in the pandemic and coming through in the pandemic in the aftermath.
Well, you packed a lot into that question. So how about we take it in two parts? I'm going to ask Ms. Wilkins to lead off. She's been leading our review of our inflation targeting framework, and then I'll pick up on some of the points after we've heard from Ms. Wilkins.
So I'll be very brief to give you time, Governor. That was a big question, an important one. You're right. There has been a lot of focus on whether or not central banks can do better than their flexible inflation targeting. And our own research shows that in some dimensions, some other frameworks can do better. So just as an example, a dual mandate where you take into account both inflation but also full employment might do better in terms of stabilizing the economy in income space. So stabilizing jobs, but at the same time, it does a little bit worse in terms of stabilizing inflation. That's just pretty intuitive. But it comes at a cost of not being as simple and straightforward in terms of what we're actually trying to achieve, and it makes it a little bit more difficult to be accountable for that, in part because you've got two targets with one tool, but also because you've got a target that is not really observable. No one knows what full employment is. When it comes to the other objectives, climate change, income inequality, on the income inequality side, it's certainly something that we can take into account when we pick a framework. But monetary policy is a blunt instrument, and they can't pick and choose where growth happens. And I'll turn it now to Governor.
The points you raise are extremely important. And as Ms. Wilkins highlighted, we are doing a thorough review of our framework. And I think what it's showing is that under some circumstances, some modifications can do better, but there's nothing that does systematically better. So I think what I would underline is that, and we're certainly going to have to, we're not finished that review, and it would be premature to, provide any conclusions really. So we're certainly looking at these issues. What I will say though is that I want to stress that we do take these things into account. The Bank of Canada Act tells us to promote the economic and financial well-being of Canadians. And the inflation target really is the way we do that. And in order to keep inflation sustainably at 2%, we need to be very conscious of what's going on in labor markets. If there's a lot of unemployment, inflation is going to fall. Inequality, and we are seeing, this crisis is widening divides in society, and is something we have been talking about. That is a concern. If this recovery leaves some people behind, the productive capacity of our economy will be reduced. The sustainability of our own recovery will be reduced. So these things do get factored in. But I think what we've learned over time is that we have to keep control of inflation while we do what we can for these other factors. If we lose sight of anchoring inflation expectations, then nothing works better. There's worse inflation outcomes, there's worse employment outcomes. And with respect to climate change, I actually spoke about this last week. It is critically important that the Bank of Canada, climate change is going to be a major force on the economy over the next few decades. It's really important that the Bank of Canada understand the implications of climate change for the economy and for inflation. It's also quite important. We also have a role to promote the efficiency and stability of the financial system. And, particularly, we're already doing a fair amount of work on the stability of the financial system. If we have a very disruptive adjustment to climate change, we're going to see big repricing of assets, big revaluation of companies. That could spill into our financial system. It could certainly impair the ability of the financial system to support the real economy. It could even lead to instability in the financial system. So we have begun last year analyzing and discussing in our financial system review climate risks, largely to the financial system. And last week, we announced a pilot project with the Office of the Superintendent of Financial Institutions and 6 financial institutions to develop scenario analysis. And that's a tool effectively. There's a lot of uncertainty about climate change and what the implications are. But the idea is uncertainty shouldn't be an excuse for inaction. And we're going to work with OSFI and these 6 financial institutions to develop some scenarios that financial institutions could use to assess their own risks and use it to help them with risk management and help and work with them to develop a methodology and an approach to do this.
We will.
The idea is to make this easier for everyone.
We will have to end that round there. That's the first time ever I've seen Mr. Julian only have one question in 6 minutes. Heavy question for sure, Peter, but you'll be on a little later in another round.
The brain is only a receiver. In the universe, there is a core from which we obtain knowledge, strength, and inspiration.